Welcome to this explainer. If you've been scrolling through the headlines lately, you're probably seeing some pretty dramatic claims about the real estate market, right? I mean, some folks are saying the sky is absolutely falling, while others swear everything is totally fine. So, today, we're cutting through all that noise. We're going to look strictly at the hard data to uncover the real truth behind those dropping property prices. Let's get right into it. So, is the real estate market crashing? It's literally the exact question keeping buyers, sellers, and investors up at night right now. Everywhere you look, you see these alarming headlines. Property values dropping in major neighborhoods, houses just sitting on the market way longer, and that wild buying frenzy of the past few years, yeah, it's completely vanished. But we have to ask ourselves, is this a catastrophic crash, reminiscent of 2008, or is it just a routine, much-needed correction after a period of totally unsustainable growth? That tension between a devastating crash and a normal market cooldown is exactly what we're going to resolve today. Okay, let's dive into this. First up, crash or market correction. Second, why property prices are falling. Third, the global real estate map. Fourth, moves for buyers and investors. And finally, predictions for the future. Section 1, crash or market correction. Let's take a purely objective look at what is actually happening right now. Right off the bat, let's define what we're talking about. A market correction is simply a decline in market prices to normalize after a period of excessive growth. It's essentially a mechanical, totally expected response when prices shoot up way too fast. Think about that massive, crazy spike in home prices we saw recently. That kind of vertical growth just cannot sustain itself forever, right? A crash, on the other hand, is a sudden, disastrous drop fueled by deep systemic failures. What the data is actually pointing to right now is a stabilization. It's a mechanical correction bringing the market back into a sustainable equilibrium. No need to panic.
So the crucial point is Section 2, why property prices are falling. Let's pull back the curtain on the macroeconomics here.
Number 1, high interest rates. Look, when the cost of capital spikes to combat inflation, it acts as a massive, immediate brake on the housing market. A mortgage that you could have easily absorbed just a couple of years ago, well, today, that same loan severely limits your purchasing power. It instantly shrinks the pool of qualified buyers at those top-tier price points. The entire borrowing landscape has fundamentally shifted, and that directly, absolutely restricts market velocity. And that leads us directly into the classic showdown, supply versus demand. Think of it like a giant seesaw. During the recent boom, inventory was sitting practically on the ground, almost non-existent, while buyer demand was stuck way up in the air at historic highs. Now, because those elevated rates are causing demand destruction, the seesaw is tipping. The dynamics are flipping. Homes are sitting on the market a lot longer, inventory is starting to pile up, and so prices naturally have to compress to come back down and meet that remaining pool of buyers. But, beyond just the raw math of mortgages, there's a very real psychological component here too. The broader economic slowdown and buyer confidence. And this hits right at your own wallet. Real estate is heavily driven by certainty. If buyers perceive macroeconomic instability or maybe some softness in the job market, hesitation becomes this incredibly powerful market force. Buyers take a step back, they extend their timelines, and that further reduces immediate demand. Ultimately, it pressures sellers into making price concessions just to get the deal closed. Moving on to Section 3, the global real estate map. Let's see how this all plays out geographically. As we all know, real estate is hyperlocal, and we are seeing a totally fascinating global split right now. On one side of the map, regions that are highly exposed to variable rate mortgages are feeling the absolute sting of high rates right this second, which is leading to some very noticeable price compression. But conversely, areas with deep, systemic housing shortages, they're actually still seeing prices rise or stabilize. Why? Simply because inventory is still way too low to satisfy even the reduced demand we just talked about. So it's definitely not a uniform global plunge. It's a deeply localized adjustment.
Let's shift from macro to micro. Section 4, moves for buyers and investors.
Now, what's really interesting about this slide is how smart investors are pivoting rather than panicking. First up, they are strictly focusing on cash flow. Since rapid appreciation is slowing down, a property literally has to make sense on a month-to-month basis right now, not just as some speculative future payday. Second, they're shifting to long-term hold strategies to ride out this current correction. And third, they're actively sourcing motivated sellers, people who really need liquidity in a slower market. That opens the door for much better negotiation and some killer off-market opportunities. And for first-time home buyers,
The strategy is equally laser-focused. Tip number 1, prioritize affordability and exact math over just the sticker purchase price. You need to know exactly what your monthly commitment is at today's rates, period. Tip number 2, leverage your negotiating power. Guys, the frenzy of blind bidding wars is over. You finally have the leverage to demand inspections, ask for concessions, and be highly selective. And tip 3, lock in your financing completely before you go shopping. In a stabilizing market, sellers absolutely crave certainty, so a fully approved buyer holds a massive advantage.
Looking at the horizon now. Section 5. Predictions for the future.
Let's move to and see how this builds across the next few years. Looking at a 3 to 5 year horizon, the data suggests a very clear timeline of stabilization. In year 3, we expect to see interest rates finally find a steady, new normal, likely lower than today's peaks for sure, but definitely higher than the extreme almost 0% lows of the past decade. By year 4, as those rates stabilize, buyer confidence is expected to return to the market, bringing back a healthy, balanced volume of transactions. And then by year 5, the data points to a return to modest, historical averages of steady price growth. The market is essentially just digesting the recent volatility and moving back towards sustainable health.
So as we wrap up, keeping a balanced view is absolutely essential here. The real estate market is not falling off a cliff. It is simply finding its footing. We are experiencing a mathematical correction driven by the cost of capital and shifting demand. It is not, I repeat, not a fundamental collapse of the financial system. Prices are just adjusting to a brand new economic reality. Whether you're looking to buy, sell, or just hold, understanding that we are simply in a period of normalization is honestly your greatest asset.
So, I leave you with this final critical question. What is your next move in the real estate market? Armed with actual facts over fear, how are you going to navigate this correction? Think about it, strategize, and make the data work for you. If you found this breakdown valuable and it helped clarify the market for you, please make sure to like this explainer. It really helps us keep creating deep dives just like this one. Thank you so much for joining me today, and I'll catch you in the next one.